reason you overtrade is because you're a silly goose and you know it. Today I'm going to talk about overtrading and why people do it, and also going over some solutions to overtrading. Overtrading is something that will happen to the majority of traders who are on their trading journey from being incompetent to being competent, from being unprofitable to becoming profitable. And firstly, let's just touch upon what exactly is overtrading. Overtrading is, in the bare bones description, is simply taking too many entries. So if you think about it, when you place an entry, you take a trade, you're exposing your capital to risk. Yes, you'll have a stop loss on. Say that stop losses equates to 1% of capital. Every single time you place an entry, that is a 1% of your capital that you are putting at risk. If you do that 4, 5+ times a session, that's 4 to 5% you are putting up every single session as risk. So, on the reasons why we overtrade, it's not necessarily going to be a strategy problem, and it's far more going to be a behavioral problem. First one on more entries leading to more profit. This is a classic that we've all heard before, and while lots of people have heard it and have heard that this is not necessarily true, it is still something that applies to so many traders. And it comes back to my first point about risk exposure and exposing that capital every time you place an entry. Just because you have more entries does not necessarily mean you're going to derive more profit from the market. Do you have more opportunities if you take more entries? Of course you do. Absolutely. It's simple mathematics. But it doesn't necessarily mean that you're going to derive more profit. And that is something that's extremely important to keep in mind. Secondly, on the reasons people overtrade, is trading on impulse and emotions, which is very closely linked to our third point here about adhering to your rules. People, if you take a trader who has been sat on his hands Monday and Tuesday and not taken an entry, exactly how they should, they're behaving themselves. But Wednesday and Thursday roll around, and by this point, they've expected themselves to take an entry. That expectation can be based on their back testing, which says they should take, say, one entry per week. Well, now we're in sort of the latter half of the week, say you're on a Thursday, and you've still not taken the trade. So statistically, in the back of your mind, you know that you should have a trade either today or tomorrow. And that's that impulse, that's that emotion starting to build because you're expecting to go ahead and take a trade. Add on to that the dopamine that you get when you go ahead and place an entry. Even if you have fully accepted the risk, a lot of traders still get that kick of excitement when they go ahead and they take a trade. And if you've come to Thursday and you've not taken the trade across a Monday, Tuesday, or Wednesday, a lot of traders just sat there and they're starting to get a bit bored. They're a little bit itchy. And that voice in the back of their head is looking for that dopamine. If you have two brains, The Chimp Paradox is a fantastic book, by the way. I've not finished it yet, but I'm enjoying it. Chimp Paradox, two brains. You have your chimp and you have your human. Your chimp is so much stronger than your human brain, which is your rational brain. Your chimp brain is that emotion. It's that little voice in the back of your head that's looking at your rules and saying, you can bend it slightly. Oh, just because you've missed out on that conference, it's okay. It's still a green light. You can go and take that trade. And it's telling you this because it wants that dopamine hit that's going to come from taking an entry because you believe if you take an entry, you're going to make more money. And that's when those rules start to bend, and that's when you start to see problems in trading. If you think of it this way, as an example, Thursday rolls around, you've not taken that entry across Monday, Tuesday, and Wednesday because you behaved yourself, but now the chimp in your back of your mind is itching for some dopamine. It's desperate to go ahead and take a trade. Say you have a style which requires a sweep of external range liquidity followed by a break of market structure. Well, you get your sweep of liquidity, but instead of being a full sweep where price drops fully below your previous level and reverses, price actually taps it, you have equal lows and it rejects and then continues back up again. Is that a proper sweep of external range of liquidity? Well, no. You've had equal lows. You've not actually had a sweep because you've not broken past that previous level that you've identified. But that chimp in the back of your brain, it's not too bothered about that. An equal low is as close as we're going to get here. We've not had an entry because Monday, Tuesday, and Wednesday, so we can let that one slide. That confluence, that tick box that your rules say has to be met for you to take the entry, just falls by the wayside, and you tell yourself, you rationalize that it's fine, it's okay, you can still go ahead and take this entry. Price comes back down, your entry is now set, it taps in, it may reverse on, take out break even, and go on to full take profit. It may go down to hit your stop loss. If it's the former, your chimp, your irrational brain is going to feel validated, and now going forward, that's going to be the new normal. But the thing with that is, you've not traded with your confluences. You've essentially gone ahead and gambled. On the opposing side of it, if you then go and on the latter half, price actually taps in and goes on to hit your stop loss, your chimp's not going to be happy. In fact, it's going to be really annoyed at you because you broke your rules, which, as I've said over and over again, and I think I will say in every single video for existence, is that you need to focus on your processes and not the outcomes. And your chimp is now going to look at you and call you a fucking idiot because instead of focusing on that process and just ticking that box, you're too busy looking to chase the dopamine, chase the entry, and chase the outcome, which means not only have you lost capital, but you didn't stick to your rules and follow the processes, which should be the main achievement here. So these are the reasons or a high level overview of why people overtrade. And next, I want to go and touch upon a quick example, which I'm actually not going to touch upon because I'm not going to insult your intelligence by explaining what the table on the right shows. Read it in your own time. You get the idea here. But I'm going to briefly talk about some solutions. The topic of solutions, I would say similar to the previous slide, a lot of these can actually be linked, one falling into the other. So firstly, we're going to be focusing on being precise with your criteria and defining the invalidation of your idea. So if you think of it this way, a trade is simply an idea which you believe statistically is going to lead to deriving profit from the market. It's as simple as that. It is an idea. Your entry criteria, your pre-entry checklists, they are part of your idea. And if you have a proper edge, a proper style in place, firstly, you should know them like the back of your hand. But secondly, they should be precise. They should be exact. They should be binary, completely, or at least mostly, quantifiable. Very, very objective. They should not be subjective to your opinion or anything like that. And they should be so my point of this, sorry, is that they should be very exact. You should know exactly what they mean, and you should be able to tick them like a tick box. Very, very simple. And the majority of you, not that there's very many people watching this, but the majority of you, when you have those rules and criteria, they will be exactly that. They will be precise. Some people have them actually overly precise, and in way too much detail is actually manageable and executable on a day-to-day basis. But on the flip side of that, not many traders seem to actually go and define the invalidation of the idea. So the most obvious way to look at the invalidation of your entry idea is your stop loss. Simple as that. Price enters, I hit stop loss, my idea is now invalid, I am going to cut my losses here. But you also need to look at the invalidation based on your entry criteria. If these boxes are not ticked, then I cannot take an entry. Some of you may have entry criteria, which is a series of different confluences that need to be met, and you need to say get like 5 out of 10 of those. I don't know, 5 out of 10 of those confluences. Me personally, I have a shorter list of confluences, 5 or 6, and I need every single one of them to be ticked because I only want to take those good old A plus setups that everybody talks about. My point here being is that don't just look at the invalidation of your idea as being the stop loss. Consider your entry criteria not being ticked off, like that tick box exercise that we speak about, is equally an invalidation of your idea. If these boxes are not ticked, I therefore cannot take this entry. It is as simple as that. And finally, just start treating this like a professional. If you're going to do some other side business like drop shipping, or no, not drop shipping, that's a bit dated, isn't it? Content creation, UGC. I don't know what UGC is, but I see all these content creators putting UGC. I just think underground cabling, because that's linked into my corporate job. But no, I doubt it's got anything to do with underground cabling. But if these content creators, they treat this like a profession, you need to do the exact same thing when it comes to trading. Be a professional. And treating this like the business that it is should be quite easy, in the sense that you can literally see your capital once you've placed the trade going up and down on MetaTrader. You can see how your investment is playing out in real time, as opposed to other businesses. Say you're starting a t-shirt company or something like that. You invest money, you're not going to see any returns, or even if that money's been well spent, for weeks or months. But with trading, the second you place an entry, you can see your return, whether it be positive or negative. And when I say treat this like a professional and be a pro, you know what that is. That it's more a feeling than anything else. Am I doing the things I should be doing? Yes or no? And you know what those things should be as well. So just treat it like a professional business that it is. It's really not that hard. And when you get into it, it feels so, so good knowing that you're ticking those boxes. That means that you are treating this like a proper profession. That is it. Apologies for the delay in this next lecture. I was in Greece, and there was not a fucking chance I was taking all this crap out to Greece with me. But yeah, I'm hoping to maybe start doing 2 of these a week. Either 2 of these a week or 1 of these a week, plus a market recap. Everybody does a market recap. So what's the point in that? And I feel as though there's more than enough information out there on the technicals and the fundamentals, but there's such a lack of information out there on the psychological standpoint of things, which is where the vast majority of break-even traders are falling short. And I know that for myself, because for a long time I too was a break-even trader. And that missing piece for me was the psychological aspect of it. And I say missing piece like it's a small thing. The missing piece was a huge thing, and it was a lot of work, but it was the thing that got me from being that break-even trader to being a profitable trader. Leave it at that. Thanks for watching.